As an individual or a business, seeing part of your hard-earned money disappear from sight in the form of taxation isn't something that always sits well with most of us. As a result, some people will go to great lengths to reduce their tax bill and, in some extreme cases, try to avoid paying tax altogether. Today, we're looking at the conflicting subject of tax evasion versus tax avoidance. In this video, we will cover the difference between tax avoidance and tax evasion, what is a tax avoidance scheme and should you use one? And finally, tax evasion. What could happen if you evade paying what you owe? Now, before we get started, be sure to hit that subscribe button as well as a notification bell to make sure you're kept up to date with all of our latest content. This really helps us to create more helpful videos and to get you free quality advice from real qualified accountants. In simple terms, tax avoidance is legally arranging your tax affairs to ensure only the minimum amount of tax is paid. Tax avoidance works within the letter of the law and takes many different forms. As an example, some of the most simple forms that you as a taxpayer have access to include holding assets such as shares in your spouse's name to make use of their capital gains tax allowances, selling off assets before the end of the tax year to make use of unused allowances, holding cash savings in an ISA so that any interest generated is free from taxation, and finally, using tax relief such as entrepreneur's relief, now known as business asset disposal relief, to pay less capital gains tax legitimately. These examples are very common and, as the majority of you have access to these avoidance measures, they tend to be looked at as sensible tax planning and are perfectly legal. Now, there are also tax avoidance schemes, which we'll talk about later on in the video, which, despite being technically legal, can still be challenged by HMRC through what is known as GAAR, the General Anti-Abuse Rule, which was introduced in the Finance Act of 2013. Tax evasion, on the other hand, also described as tax fraud, is illegal and could end up resulting in the criminal act of paying less tax than is legally due. Examples of tax evasion could include understating income or overstating expenses deliberately, or the complete omission of income or other information to HMRC. Now, just before we continue with today's video, we are thrilled to be launching the Accounting and Tax Academy membership site in April 2021. We'll be posting downloadable resources, tax tutorials, and in-depth courses that you won't find anywhere else. And the best part is, it's absolutely free to join. Our community have already saved over £1 million in tax, and we're just getting started. Click on the link below to register your interest today. As some laws can be subject to interpretation, it's become more and more common that third parties will design specific tax avoidance schemes aimed at individuals or businesses with the sole purpose of paying less tax. Now, let's be clear here. General tax avoidance, that's sensible tax planning, and abusive and artificial tax avoidance schemes can be looked upon as two separate things. Although these tax avoidance schemes do their best to stay within the letter of the law, they are usually manipulating the law in a way that was not intended to be possible. The GAAR, or General Anti-Abuse Rule, aims to counter these artificial or abusive tax avoidance schemes. If you are taking part in a tax avoidance scheme, you are expected to disclose the details of the scheme to HMRC, normally through your self-assessment tax return. If you do not disclose the use of a scheme and are later found to have been taking part, then you could be subject to harsher penalties. HMRC defines a tax avoidance scheme in the following way. A tax avoidance scheme involves bending the rules of the tax system to gain a tax advantage that Parliament never intended. It often involves contrived, artificial transactions that serve little or no purpose other than to produce this advantage. It involves operating within the letter but not the spirit of the law. So, should you use a tax avoidance scheme? Well, in order to answer this, you need to make an informed decision. HMRC maintain a list of known tax avoidance schemes on their website under their Spotlights section. Click on the link in the description box below to go and have a look at some of these. If you are approached by a third party or discover a tax avoidance scheme, it's always advisable to read HMRC's view on it under the Spotlights section. Even if the scheme is not listed on the HMRC website, they will expect you to disclose the details to them if you have entered into and participated in the scheme. Now, it's not to suggest that all tax avoidance schemes are out of the question, as sometimes there is a very fine line between avoidance schemes and those HMRC would claim as abusive under GAAR. We suggest you follow these 4 general rules to reduce your risk of being caught up in an artificial or abusive tax avoidance scheme. Number 1. If the promoter of the scheme insists it's HMRC approved, then be suspicious. HMRC never approves any schemes. Check out HMRC Spotlight, and if the scheme is listed on their website, then you should make your own informed judgment. Number 2. If the promoter suggests you don't have to declare the scheme, even if it's not listed on HMRC's Spotlight section, again, be suspicious. Perhaps this would be the opportunity to get a second opinion from a professional advisor, such as an independent accountant or tax advisor. Number 3. Round in circles. Where the aim is to move your money round in a circle with it ending up back where it started, this can also be an indicator of a tax avoidance scheme. And finally, number 4. If it sounds too good to be true. Spotlight 33, contractor loan schemes, was such an example where promoters were promising that a contractor could take home 90% of their income. Many contractors unfortunately fell for this and happily received up to 90% of their income as take-home pay. Eventually, HMRC caught up with this scheme and clamped down on it, including recovering retrospective taxes from thousands of contractors who had used the scheme, which was quite a sting. If you're in doubt or believe you are currently in or have historically entered into an abusive tax avoidance scheme and need further help, we always suggest you seek an independent professional opinion from a qualified accountant or tax advisor. Tax evasion, if proven, can have serious consequences. HMRC have a fraud investigation service, the FIS, a department that employs over 4,000 people. But firstly, it has to be investigated, and for civil cases, HMRC operate under the following areas: Code of Practice 9 and Code of Practice 8. Click on the link in the description box below to download HMRC's version of each. Don't forget, it's not down to HMRC to decide whether a tax fraud case is criminally prosecuted. HMRC's job is to make the case for prosecution through their powers of investigation, and the decision itself is made by the Crown Prosecution Service in England and Wales or the equivalent authority in Scotland and Northern Ireland. In other words, you could end up in court and face a jury. I hope this video has helped you learn some of the high-level differences between tax evasion and tax avoidance and taken you one step closer to knowing your numbers. As always, let me know in the comments your thoughts on today's video, or if there are any other topics you'd like to see us cover in the future. Finally, be sure to like and subscribe, as this really helps us to get our content out there. This is Matthew Shoughton for the Accounting and Tax Academy. Thanks for tuning in.